You spend weeks analyzing charts and drawing trend lines, only to watch a single, unpredictable spike wipe out your entire position. It is an incredibly common frustration. You can do the math perfectly, read the momentum indicators right, and still lose capital to a sudden macroeconomic shift. This steep learning curve inevitably leads people to a very practical question. Is there a way to simply mirror the exact trades executed by seasoned professionals? You might have heard of copy trading pitched as a passive, flawless shortcut, where you just click a button and let the profits roll in. That is entirely false. The real function of copy trading requires a complete shift in how you operate. You step back from actively trading currencies, and instead you take on the role of an auditor, intelligently managing the people who do. At the mechanical level, copy trading uses software to bridge two brokerage accounts. When a professional master opens a position, the exact same trade triggers in your follower account. To understand proportional copying, let's compare two accounts. A master trader has $10,000 and your account has $1,000. If they open a one-lot trade, the software opens a 1/10 micro-lot for you. 5% gains mean identical risk and reward percentages. This mechanism ensures that a smaller portfolio is never over-leveraged, automatically enforcing the professional's exact risk management parameters, regardless of the capital difference. Most people fail early on because they open a broker's leaderboard, sort by the highest all-time return, and blindly follow whoever sits at the top. This chart shows why raw profit is misleading. If a trader boasts a massive return, but their maximum drawdown was 75%, that indicates a dangerously reckless strategy. Could you handle watching 3/4 of your money vanish in a single afternoon? To protect your capital and your mental state, you should prioritize traders who maintain a maximum drawdown firmly under 20%. Next, you need proof of longevity. Anyone can get lucky for a few weeks by doubling down on bad trades. You want to see a minimum of 6 to 12 months of verifiable history to ensure the strategy holds up across varying market conditions. True professionals aren't defined by their ability to hit massive lucky windfalls. They are defined by their strict discipline in capping losses when the market turns against them. Even with the perfect trader selected, you must account for the physical constraints of technology. Execution latency is the millisecond delay for a trade signal to travel from the master, hit the broker server, and finally execute in your account. In a fast-moving market, this brief execution delay means your trade may enter at a slightly worse price, a gap known as slippage. Slippage is devastating for a scalper targeting tiny gains, but mathematically irrelevant for a swing trader capturing large trends. Understanding this friction dictates your strategy. If you rely on split-second execution, the physical limits of the network will steadily bleed your account dry. No matter how thoroughly you vet someone's drawdown and longevity, they are still human. A sudden market shock can cause even disciplined veterans to panic and abandon their rules. To shield yourself from a catastrophic failure, you employ an equity stop-loss. This is a hard, mathematical limit you set on your own account. If the master's open trades lose a specific dollar amount, the system immediately severs the connection and closes your positions. Establishing this boundary ensures you are never exposed to infinite risk. Protecting your downside is the primary responsibility of capital management. Tying your entire balance to a single individual leaves you highly vulnerable. If their specific methodology struggles in a flat market, your entire portfolio stagnates. As this chart demonstrates, the safest approach is to divide your capital into a basket of non-correlated strategies. By pairing a trend follower with a mean reversion trader, you smooth out your returns, offsetting one person's temporary weakness with another person's strength. Because this process resembles active investment management, strict regulatory bodies like the Financial Conduct Authority provide heavy oversight to ensure transparency and security. The best way to start is in a simulated environment. Open a demo account, apply the risk metrics we discussed to filter for consistent traders, and watch how their actual trades execute over a few weeks without risking a single dollar. Copy trading is a powerful tool for utilizing expert analysis, but success requires treating it like an active audit, applying strict standards, demanding consistency, and relying on hard math rather than hope.